Hello, beautiful people. Welcome to the Energy Africa Café. My name is Busayo Omofe. I am an energy analyst with a focus on research, project organization, and capacity building. And I am more than privileged to be your host for today. We have an incredible person as our guest for today. His name is Ifechukwude Uwajeh. Thank you, Ifechukwude, for joining us.
Thank you, Busayo and the team, for having me. It's my pleasure.
Thank you. Ifechukwude is currently the Managing Director of Blended Finance at GreenMax Capital Group. At the MD Blended Finance, he leads the Smart Outcome Fund window of 82.9 million euros Clean Energy and Energy Inclusion for Africa Foundation, CEI Africa, funded by the German Investment Bank, KfW, and the Swiss Agency for Development and Cooperation, SDC. His role includes leading design and implementation of blended finance products such as first loss products, outcome, or results-based grants. He holds an executive MBA from Cranfield University, United Kingdom, and a master's degree in process systems engineering, also from Cranfield University. He also holds a qualification of certified expert in climate and renewable energy finance from the Frankfurt School of Finance and Management, and a certificate of excellence in power sector regulation from the Florence School of Regulation. And it's also interesting to know that he holds a bachelor's degree in chemical engineering. Thank you for joining us again. How's your day going?
Going quite well, Sayo. Thank you. Thanks for asking.
You're welcome. So I think this is what everyone wants to know. And I want to know how we got into the energy sector. And I think every young person finding their foot in the energy sector will also like to know this as well. So what made you say yes to the energy sector, especially seeing that you are an engineer dealing with finance?
Well, I'll say that's the answer to that question is a no-brainer, right? Because, like you mentioned, I have a couple of engineering degrees, an engineering background. I started my foray in the energy space in the project development aspect of power and electrification. But by project development, I mean project development of, at the time, large IPP on-grid projects in Nigeria. This was back in the day when we had quite a few thermal power plants coming up. So I worked on gas, and I dare say, to the chagrin of most people, coal-fired power projects at the time.
Thank you. That's quite a journey, and I'm happy you gave us a background of how you started. And this is going to lead to my next question, because many early to mid-career professionals struggle with financial modeling and investment structuring. So given your extensive experience in developing financial models for both on-grid and off-grid projects, what are the most important elements needed for energy projects, financial models, and how can professionals sharpen their skills? Please, I need you to be very detailed, because I myself, I struggle with financial modeling a lot.
Well, I'm glad you mentioned financial modeling, because that's a critical in-demand skill in finance. And for some reason, people seem to gravitate away from it rather than towards it. And it's quite important in our journey as we progress towards full sustainable electrification of our very, very critically underserved populations, that we not shy away from the difficult aspects or learnings on our journey, right? Just double back to when you asked about my background. So I did power sector project development, large projects, IPP projects, and so on and so forth. It was, like I said, it was fun. And why it was fun is that we were actually working to move the needle, right? The power sector, what I call the power imperative in Nigeria, is one that we really, really need to very quickly solve for. And in developing that, in my journey, and I think I've mentioned this previously, that my journey developing projects as a team member in a large team developing large multinational, multidisciplinary team developing power projects, I got to realize something, right? That the challenge was not the technology, right? It was not whether it's the gas power plant. It's not whether it's just a simple cycle or a combined cycle gas power plant. Those technologies have been around for ages. Even in the renewable energy space, the solar, the hydro, and so on and so forth have been around literally for a decade, right? So what was actually frustrating, right? And if I could describe the start of my journey, I would say it was all excitement and glee until a point of real frustration. And that frustration was a frustration that was caused by a lack of I'll say, a lack of financing solutions. There was also some lack of willingness, I say, to implement certain financing models to advance electrification. And that was quite frustrating, again, because the technologies are tried and true. Some of them have been in place for over 100 years. The plants that have been operating for literally decades, right? And so the challenge is not a technical one. And if you look at the power space, particularly in Nigeria, the large on-grid power space, right? The delays to critical IPP projects were mostly due to disagreements around some sort of financing or credit enhancement. In the case of Azura, there were delays because of the PCOA. In the case of the 14 stranded solar on-grid projects, it was a bouquet of issues, one of which was a disagreement on the risk bearing and risk allocation, including in the PCOA. And so when you look at how these issues have still begun to fester or had cause to fester, you would notice that there's one key element that keeps on cropping up: finance. And that's one of the reasons why, going back again to the second question, which you asked about financial modeling, the power deficit, or the power deficit imperative that we have, the imperative to solve this electrification challenge in sub-Saharan Africa, is one that demands, as in like complete focus, right? It demands that we roll up our sleeves and literally get to work. We don't shy away from what would be what we perceive as a bit challenging, because indeed it will be challenging, but it's worth doing at the end of the day. So when you talk about financial modeling, there's quite a few aspects, right, to financial modeling activities, from auditing a model, reviewing a model, and then going on maybe to develop an actual full-fledged model. And since you were asking about the important aspects as it relates to learning, let me delve into a few. And this is in no particular order. I'll just list a few. So the structure of the model is one that's very important, right? Yes, you have a basic template of an Excel worksheet and workbook, and then you start plugging in stuff, right? And you could have a reasonably accurate financial model with valid inputs and formulas result, and you could spit out plausible outputs. But if it's poorly structured, it's going to be very tedious to use, right? And I recall that one example of a very popular modeling standard is the FAST standard, and I believe a lot of people use that. So the structuring the presentation is one which is easily overlooked by people of a more technical bent. And when I say technical, I mean technically financial in this sense. So it's important that this is not overlooked. Another important aspect is the plausibility of a model's outputs are literally only as good as the inputs upon which they are based. So pay close attention to this. This is one reason why in most project finance transactions, the model is only crystallizes just before financial close. It's an evolving document which keeps getting updated as the inputs become more actionable, right? So you start off maybe at the beginning of the project development life cycle with the model with numbers from with inputs and capex inputs from maybe a bankable feasibility study, right? And then you progress to a model towards financial close, which has actual cost inputs from suppliers that have maybe frozen costs for a period for that project, right? So you progress towards one which the margin of error is very large, to one that has a much tighter tolerance, and which eventually becomes the lender or the financier's model. So again, the inputs, it's very important to pay very close attention to every single input, whether they're inputs that are publicly available or they're project-specific inputs. It's important to pay close attention to them. And then when you're working with a financial model, I would say don't take anything for granted. It doesn't matter from whom you receive a model. It's not a very wise course of action to assume that any model is 100% kosher, 100% correct. On my part, worked with, reviewed, audited, built a number of models for different categories of projects: grid, off-grid, embedded power generation, as we call that very gray area. here in Nigeria. And I'll tell you something interesting. I'm yet to see a model without at least one error, whether it's a material error or something that's more cosmetic, but I've not yet seen a model without an error. So again, don't take anything for granted. The most important aspect of learning to build financial models is just start building the model already. You're not going to learn how to build a model by reading notes, no matter how copious or voluminous or how informative, or even reviewing one yourself. You can be tasked with reviewing a model and you might get a fairly good understanding of how a financial model works. But the most important thing would be for you to build one for yourself. The learnings that accrue from such an activity are the type of learnings that stay with you and that actually build competence in modeling.
Wow, thank you so much for that. That was very detailed, and I really appreciate how you took your time to answer the questions. In your role as the managing director of blended finance at the GreenMax Capital Group, you lead the Smart Outcomes Fund window at CEI Africa, overseeing innovative financial models like performance-based grants and the rest. So many people actually struggle with things like access to capitals. That remains like a major barrier for sustainable infrastructure. So the first question I'm going to ask is, can you break down how these financial mechanisms work in practice? And more importantly, how can we de-risk investments for clean energy projects?
Okay, thanks for those questions. So you're given at the start of the discussion a brief overview of CEI Africa. So I'll just recap that so that if anyone missed that, they understand what CEI Africa is. CEI Africa is a foundation. It's funded by the German Ministry for Economic Cooperation and Development, BMZ, through KfW and the Swiss Agency for Development Cooperation, SDC. And it is implemented by a consortium of three parties: Triple Job, GreenMax Capital Advisors, and Persistent Energy Capital. It comprises two windows, what's called the Smart Outcomes Fund window, which I'll discuss in more detail, and the crowd lending window. Now, these windows provide grants, technical assistance, and loans under one operating entity, which allows them to share KYC and intake processes. And of course, because of this, that allows for unique efficiencies and speed of both the foundation, both CEI Africa as a foundation and a grantee or borrower, because they're not overburdened by different providers of financing, grants, and technical assistance with their own usually individual and varied processes, right? So I mentioned the crowd lending window. I won't delve too much into that, but the crowd lending window provides loans and typically subordinate loans, and it brings on crowd lenders to provide financing to projects, whether under the CEI Africa umbrella or also might not also be beneficiaries of our grant window. And this in this implementation, the crowd lending window is able to bring on individual European private investors to actually invest in energy access projects in Africa. So that's one aspect of de-risking, and this sort of leaps ahead to answer your second question. That's one aspect of de-risking, because CEI Africa's crowd lending window will typically take a subordinate position and enable the entry of more senior debt, again, typically through the crowd lender. Okay, so let's talk about the Smart Outcomes Fund window, which you asked about. So the Smart Outcomes Fund window is currently being implemented in sub-Saharan Africa, and it has two components. The first of which is a results-based finance component, which provides output-based, results-based grants and forgivable loans to green mini-grid developers. In the RBF component, we are live in 4 countries now implementing: Mali, Benin, Kenya, and DRC. And the RBFs are traditional, and it's basically the tried and true model of the payment of a grant per connection post completion of a project. One very nifty and interesting bit that we tacked on at CEI Africa to this RBF component was the first forgivable loan product, which was developed by GreenMax for mini grids. And that forgivable loan product is a quasi-equity construction loan. It's typically senior only to owner equity in a construction capital stack. So what that does, what the forgivable loan unlocks is that it unlocks even larger portfolios of projects by mini-grid developers, resulting in even greater impact. When you ask developers, and I'm sure you've interviewed quite a few of them across sub-Saharan Africa, you'll find out that particularly for the local developers, one of the key challenges that they have is the very, very real dearth of equity. Again, that's a topic I've spoken on a number of times in the past. There's a real dearth of equity, of a similar equity type investments in the mini-grid space in sub-Saharan Africa. So what we enable through this pre-construction quasi-equity product called the forgivable loan is financing, which throws up the equity base of the grantee and allows them to draw on larger pools of debt, leverages even larger pools of debt, and of course enables more projects, bigger portfolios, and at the end of the day, more impact. There's a second component of the Smart Outcomes Fund window, and that's what we call the soft component of CEI Africa. This is also live. We have deployed across sub-Saharan Africa, and that component provides outcome. Remember that the RBF component provides output-based RBF. The soft component provides outcome-based, results-based financing to productive use of energy businesses. And there is also tacked onto it a forgivable loan component, which operates in a somewhat similar manner to the forgivable loan component under the RBF component. Of course, in both of these components, we've built in technical assistance, which is available to developers who need assistance to maybe bridge last mile deficits, which might be preventing them from qualifying for grants under CEI Africa, and also for developers who require post-construction or post-implementation support to meet operating or reporting requirements of the foundation. So that's why you might have heard CEI Africa, maybe on some other fora, referred to as one-stop shop. And that's how we also describe it, literally a one-stop shop. Under one roof, you have technical assistance, you have forgivable loans, you have results-based grants, you have also debt and investments, right? So with the efficiencies that are afforded, developer can come in with a shovel-ready project, receive technical assistance as may be necessary to make that project a qualifying project, or if technical assistance is not required, they can access results-based grant and also access the necessary loans to implement the project, taking them all the way to construction and delivery of, whether it's in the case of mini-grids, electrification, in the case of productive use of energy, improved economic outcomes for the beneficiaries that are in that particular project location. And you asked, I recall, you did ask the second question, that how do we de-risk investments? Well, I already started out to describe de-risking methods, and we can de-risk investments through applying blended finance instruments, right? And it may be interest you to know that all of these products that I've described have been blended finance instruments, whether it's results-based grants, whether it's DFI funded concessional loans. These have all been blended finance instruments. And what the Act do is to resolve the very question that you asked, to de-risk investments. In the case of results-based grants, right? Results-based grants provide viability gap support. So bridging the viability gap for projects that would not otherwise be viable. And because of a results-based grant, lender or other financier is able to take a look at a project that they would otherwise not have considered and see that the viability gap has been closed by a results-based grant, and the project has thus become bankable, and decide to participate in it. So we saw in Nigeria under the NEP a number of local currency financiers come in to provide fairly large pools of lending, of debt to the mini-grid developers to implement portfolios, something that would have been thought impossible some maybe 6-7 years ago. That asset class would have been viewed as too unattractive, too risky to attempt an investment in. And the entry of results-based grants was a game changer, and we can see that that has resulted in, of course, a progression from NEP to DARES today. And this is pretty much what we see as well at CEI Africa. Our grants, our results-based grants, whether it's in Mali, whether it's in Benin, and so on and so forth, enable the entry of additional private capital to leverage projects. Progressing now to the concessional loans that CEI Africa provides. Those concessional loans also de-risk investments, right? Because, like I said, typically the crowd lenders would not participate in mini-grid deals, but the presence of the products of CEI Africa, or blended finance products, which are the grants and the concessional loans, which are willing to subordinate to the loans from the crowd, that provides sufficient cushion, sufficient cover, sufficient first loss protection to the crowd lender that they're then willing to participate in lending to these projects. So these are some immediate de-risking models which I can very easily describe. There are literally a host of them, and we could go on to talk about more advanced instruments like credit enhancement tools. We've seen in a place like DRC, we've seen the World Bank's MIGA provide political risk cover to a developer of large mini grids. Now, those mini grids are so large that they're named differently, right? They're called metro grids, right? So we've seen MIGA provide political risk insurance cover to a developer of large metro grids, which anywhere from 4 and above, even all the way up to 11 plus megawatts. And what that does is that it allows the participation, it allows the entry, or it enables the entry of investors that would otherwise not have been willing to participate or to make investments in the off-grid space in DRC.
Thank you so much for that. That was very in-depth. And still on the topic of structuring bankable projects, right? I'm going to touch on power purchase agreements. So negotiating power purchase agreements and structuring credit enhancement packages is a critical avenue to unlock investment in energy projects. What would you say are some of the factors overlooked by developers when structuring these agreements, and how do you overlook this problem, these factors?
Okay. Well, pretty good question. See, two different but related topics, right? And it's important to note that power purchase agreements, or PPAs, let's use the acronym, are very seldom prepared by the developers themselves, right? In more mature markets, templates PPAs exist, and those template PPAs might have very few areas of flexibility. Maybe you might recall that the Nigeria Bulk Electricity Trading PLC, NBT, which was the bulk trader under the EPSR Act, it actually had such a template, and this template was developed after learnings of the first power procurement transactions, right? But of course, the legal advisor to the developer may actually develop the PPA template if needed. But I would need to clarify that this is in cases, again, where the market is typically not mature enough, where templates already exist, because a PPA is a complex document and it is quite costly to develop a properly structured one. So what the developer would say should not overlook is the basic premise that the PPA is not just an offtake agreement, right? It is also typically a risk allocation document, right? And it allocates risk to the parties most suited to bear that risk. And if there's any mismatch in this regard, it will likely render that project unfinanceable. I'll give you a very quick, let me see if I can pull up a very quick example from experience, right? If you have a PPA where the national grid, because you know that the grid is typically owned by governments. It's by its very nature, that utility is owned by governments in most cases, right? So you would expect that transmission risk in the PPA should be allocated to the government, right? But if there is any failure in the transmission capability or the ability of the transmission company to wheel available power from a generation source, you would expect that transmission company that was unavailable when the generation company was available to dispatch power would be the one to bear the responsibility for that event. So that's how that's sort of allocation that you would typically see under a PPA. If the risk is allocated in such a way that the grid could go down due to an event that is not of the making of generation company, and the generation company does not get compensated in any manner for this unavailability of the grid, whether it's through the payment of capacity charge or a deemed generation charge, depending on the type of generation technology we're talking about. What you would actually have as a result is that a financier, typically a lender, would see a gap and know that in such an event, which could actually be a prolonged event, they would not get any returns to pay the loan. There will not be any revenue generated by the plant to pay the loan. And that would cause a lot of issues. And even if you have credit enhancement is not what you always want to draw on. Whenever you have to draw on the credit enhancement, whenever you have to call on one of your credit enhancement instruments that you've already tacked onto your project, that means there's already an issue. So again, you want to be very, very careful in allocating risk in a PPA, because that determines the bankability, the sole determinant, but it is an important determining factor of bankability in projects, in power generation projects. You asked again about credit enhancement instruments. Again, sorry, one second. So for credit enhancement instruments, the level of participation of the developer in crafting these instruments depends on the category and size of the project. Again, it is typically limited. A developer typically has a very narrow rule here. I'll explain. For large projects, credit enhancement instruments will typically require agreement for indemnification by a sovereign. And this, what I mean by this is that there is typically an agreement between the sovereign, which is a government, to the provider of such an instrument. So whether it's the World Bank's, whether MIGA on behalf of the World Bank providing a particular risk insurance, or PRG from the IBRD, or PRG from the African Development Bank, and so on and so forth, there will be between the provider of that credit enhancement and the government of the country an agreement, an indemnification agreement, which ensures that when the credit enhancement instrument is called and payments are made, that at the end of the day, that the provider of that financing will be made whole by the sovereign that provides the indemnification, that is contractually bound to provide that indemnification. So these instruments for these categories of projects, for these large power projects, are typically not intended to be bespoke, right? They are very, very complex documents which are negotiated with, which development is typically negotiated with governments, and it's not very easy to change them, right? So there's again limited scope for a developer to influence the material aspects of that of such a credit enhancement agreement. I think, for instance, if I remember correctly, the PRG instruments from multilaterals a number of years ago were agreed with the federal government of Nigeria itself through the Ministry of Finance, and that the responsibility was now to the bulk trader to nominate power projects deserving of PRG support. I seem to recall that that's the way it worked. So again, limited wiggle room for a developer who goes to the bulk trader, negotiates a PPA, and requests PRG support, and then the bulk trader reaches out to the Ministry of Finance and then nominates a project and so on and so forth. And then the Ministry of Finance approaches the provider of the credit enhancement, right? So you would see that there is, of course, limited participation, I reiterate that, of the developer in the actual negotiation of such an instrument. Smaller projects might not require indemnification by sovereign. That's possible, yes. But again, there's still seldom any flexibility on the terms of credit enhancement or any credit enhancement proposal offered. Because again, the providers of these credit enhancement instruments, the multilaterals and the likes that provide them, carefully craft these products to address specific bankability gaps in markets, and then make them available, make the products available, the instruments available to those markets. And the cost of developing such a credit enhancement instrument does not lend to bespoke applications. So there's limited wiggle room because the risks have already been assessed, theorized, and the credit enhancement designed for those risks.
Thank you so much. I think what everyone's going to enjoy is how you've been very detailed when answering these questions. And I appreciate that so much. Thank you for taking your time to join us again. And my penultimate question is going to focus on career transition. So looking at your background, you're a technical assistant, you work at MTN, you moved to Zuma Energy, and now you are at GreenMax Capital Group. Looking back at your journey, you've transitioned from like leading hands-on engineering projects to negotiating multi-million-dollar projects, right? So in shaping these deals and this transition, one question I'd like to ask is, what are some of the unconventional things that or skills that are often overlooked that helped you successfully bridge this gap and between technical experiences and financing? How are you able to balance all this and the transition? How are you able to manage all this?
That's a good one, but I'll tell you that it's not a technical skill. Actually, it's more of a soft skill. It's great, actual great. Like just the determination to say, okay, this is actually what needs to be done, right? I had seen that the gap in the industry, I'd seen the frustration from both developers, from both financiers of who were actually affected by, let's say, very tardy progress negotiating key enhancement instruments, right? I'd seen the fact that all of the technical stuff was in place, again, it was not a technical challenge, right? It was the financing challenge, right? And it was a no-brainer for me to just say, okay, this is what needs to be done. This pivot needs to be, I need to get into the financing bit so that we can craft blended finance solutions and other types of similar credit enhancement tools that would actually unlock the capital, right? Because it's like a dam when it's open, right? Those first projects, those first very, very delicate, risky projects, which take pioneer risks, which are at the forefront, right, of championing the electrification cause. They will take a lot of risk. They'll get, but in succeeding, what will eventually come out of their success, the learnings that will come out, will enable much more affordable, sustainable, and widespread electrification of our people here in sub-Saharan Africa. So it's not a hard skill. It's more of a soft, nuanced one.
Thank you so much for that again. And still on career transitioning, I think there's a common culture that is very popular on LinkedIn. So people associate or assume getting certificates to then becoming experts. So like you see like, oh, somebody took like 3 months course and all of a sudden they're a technical consultants in something or something. So the question I want to ask you now is, beyond these certificates, what are the things that we need to know, especially for young people getting into the power sector, people just starting their careers? What are the things we ought to know that these certificates don't just cover? Like maybe we have to like learn, it could be soft skill, it could be technical skills. Like what are the things we just need to know to ensure that we are grounded, not just with certificates? Thank you.
Good question. And again, let me preface this with a caveat. Qualifications are awesome. Like, no one should get me wrong. They're awesome. Get the learning. Any relevant learning you can get, please go right ahead and get it. We talked about financial modeling at the earlier part of this discussion. One thing that's very important, you touched on it, this is critical in developing a career in the energy space, particularly, is to get involved. Right? You actually do need to get involved. And in getting involved, you might have to get your hands dirty. So don't be shy to get your hands dirty. Seek out internships. Go intern at a mini grid company. There are a number of them in Nigeria doing great things under any of the World Bank enabled programs. Find out how that part of the off-grid space works. What are the actual challenges, right? How did the mini grid industry move from developing mini grids with very low capacity utilization to developing mini grids that now have in some areas, some developers even have oversubscribed mini grids, and they're having to raise capital to build contiguous mini grids around those viable sites. So how did they do that? They're at a distribution company and understand distribution grids, understand when discussions are had about distribution franchising, understand technically what that would involve from the distribution level at a disco. Understand the C&C challenges, the aggregate technical collection, commercial and collection loss conundrum firsthand. intern at a financing firm and understand the breadth of effort it takes to structure deals to enable financing to projects. And these financings could be whether challenging types or traditional types, because that's what affords you the learnings, these hands-on deep dives, right? For the financing part aspect of one thing that's not immediately obvious from just reading, right, is the level of complexity of structuring and closing a deal for a small project. And it would surprise a lot of the listeners to know that there is economies of scale in this, even in the financing space, right? The level of effort it takes to close a deal, to finance a $1 or $2 billion project is close to the level of effort to finance a $50 million project. So that's one of the reasons why you have a lot of financing companies or financiers who will tell you that their minimum ticket is so and so because they've assessed the amount of effort needed to get small deals done, and they know that it is significant, and they just don't feel it is worth their while. Your financing cost at the end of the day might equal or almost equal the loan in these small transactions. So again, it's important that you actually get in, take the risk and intern, as in get your hands dirty, intern at any one of these, or even more aspects of the energy space, right? I will give you a very real example. Right? I had a mature international intern who interned under me, took a decision to pivot to the energy space. Currently, he's the vice president of a multinational energy solutions provider. Now, that took grit. It took grit as a senior citizen, as a mature career professional looking to change professions. It took grit and it took humility to decide to approach an energy finance company, to intern, to learn, really taking the learnings and to apply themselves fully, and then eventually go on to take those learnings, build on them, develop a really rock star career in the energy space and become what they are today. So that's my summary of the little contribution I have for any individual looking to go beyond qualifications to actually getting their hands dirty in the energy space.
Thank you. I found gems, I found diamonds in a lot of things you've said, and I can't thank you enough for that. Thank you so much. So the final question I'll be asking what's that one song that empowers you to get into the zone before you go for a big meeting or deal with your day at work?
Okay. Well, first of all, thank you to the entire team for having me. Again, you might have been able to tell from my very spirited responses. This is a passion of mine. The energy space is a passion of mine. I am a very, very firm believer in applying ourselves fully, applying all learnings and all innovations that we can apply, both technical and financial, to ensure that the next generation, I don't know whether we can fully achieve this in our generation, but that the next generation don't shout up NEPA in Nigeria. Okay, so to your question about the song, that's a really nice one. Quite simply, I think I would go with Bruce Springsteen's Dancing in the Dark. It has been a very, very strong favorite of mine since childhood, and that's one song that really fires me up and gets me going.
That's quite interesting, and I think I'm going to go and take a listen to that because I don't know that song. That I do not know that song. So I'm going to take a listen. Thank you for that. And to our listeners, I want to say a very big thank you for joining us to this point. I hope I would find you in the next episode. And trust me again when I say we have incredible people for you. And Mr. Uwajeh, I can't say thank you enough for giving us the time, for sparing your time to give us these diamonds. As I've said earlier, these diamonds you've given us to help us grow our careers. Thank you so much once again. And I'm going to call it a wrap here. Have a fantastic day, everyone. Bye.